Okay, well, let's begin. First of all, I want to thank everybody for joining in today. We're going to, as you know, talk about estate issues, second marriages, and blended families. Some of you are familiar with the VisionWorks software, some aren't. So I'll give you a little bit of a tour first, just so you can more easily follow me when I'm moving around on the screen. Also, before we begin, as you well know, this is available for CE credits. And for us to be able to issue a CE certificate, we need to have your contact information. So at some point when we're done, if you would return to our website, go to the Contact Us page and complete this information, and then in comments just put in estate issues, and then we'll be able to send that webinar back out to you. And I'll go back to this web page a little later just to remind you about doing that. So the first question is, why are we doing this webinar? What's the importance of second marriages and blended families? And the answer to the question is very simple. The latest statistics indicate that the current divorce rate in Canada is 43%. So the question also is, if the issue is so important, why is this often neglected in plans? And I'm going to suggest to you that the answer is very simple. Other planning software does not properly model wills. And because it doesn't do that, it makes certain assumptions about assets and beneficiaries. So today what we'll do is we'll go through some of these issues and talk about ways that we can address them. We don't have an overwhelming number of people on the call, so if you'd like to...
Now joining Tracy Salverson.
If you'd like to speak up and ask questions as we go, please feel free to do so. So first of all, I just want to orient you to the software. You can see over here on the left something called a menu bar, and you'll notice, a navigation bar, and then you'll notice different categories: homes, lifestyle, family, career, etc. And creating entries in the software is a matter of using the appropriate buttons. So I use the cottage button, and you'll notice that I've created a cottage in Bill's name. So what we'll be talking about today is Bill, Sue as second spouse, and Bill Jr. as Bill's son from the first marriage. In fact, if I go to the About page and go to the family tree, you can see that I've set it up this way, that Bill Jr. is, Bill's son from a previous marriage. Before I get into wills, one of the other things that I want to point out is if we go to pensions and RRSPs, for example, you'll notice that there's a beneficiaries item. So it's typical for registered plans, TFSAs, RSPs, defined contribution plans, to actually indicate who the beneficiary is directly in the plan. So you can see that Sue's the beneficiary, and on Bill's death, the RSP is going to be transferred to Sue's RRSP. We can also say the same thing about life insurance policies, that beneficiaries are designated within the policy itself. So let's go to the Will tab and get oriented to it, gain the ability to properly model people's wills. Now, one of the things that I will point out is some people don't have wills or don't have valid wills. For example, they may have changed their province of residence. If that's the case, all you need to do is deselect this checkbox, and all of the will features are disabled. And what happens in the estate forecast, which we'll be looking at in a moment, is that we actually show the impact of provincial intestacy laws. And of course, we all know that those are fairly nasty. So let's just talk about the basics of a will for a moment. there are three things that happen. Specific assets can be cited in a will and beneficiaries designated. So in this case, I've got the cottage going to Sue. A second thing that happens is that dollar allocations can be mentioned in a will, and that would be the case where somebody says, I bequeath to my niece Susie $25,000. It doesn't matter if I die today or in 20 years' time, what I'm going to give Susie is a specific dollar amount. And then the third thing that wills do is they talk about the percentage allocation for what's called the residue of the estate. And the reason that they talk about a percentage allocation, which ultimately translates into a dollar amount, is that we don't know when we're going to die. So we don't know the value of our non-registered assets. We don't know what our terminal taxes will be and so on. So what a will says is when I die, whenever that is, whatever the value of my estate is, I want to distribute it in the following percentages. So in our starting example, you can see that Bill's leaving everything to Sue, the TFSA, the RSP is going to Sue, the cottage is going to Sue. And this would be typical of other software. So if we go down to solutions, and again, kind of the first time we do this, I know that it's going to be a little foreign to many of you.
Now joining.
But if we go to solutions and the estate tab, what we see is what Sue's going to receive. And she's going to get Bill's half of the house. It's joint tenant right of survivorship asset. Assets named in the will, which are the cottage. And I actually also have a piece of art mentioned. She's going to get the percent residue, 100% of the residue that's left over from Bill's estate. And then assets named outside the will would be the beneficiaries of things like RSPs and DCPs, TFSAs, and so on. And again, this is at Bill's life expectancy. If I click the Show Table button, you'll see how we arrive at this residue for distribution. It's the liquid assets of Bill's estate at death, and these are the non-registered assets, bank accounts, non-registered portfolios, and so on, less any taxes, and the taxes aren't much because we've set everything up so that it's a spousal rollover, and then less any probate fees, we get the after-tax residue assets. And you can see the residue for distribution is $187,000. You'll remember that on the will tab, we said that Sue was getting 100% of that residue. So we can see the percent allocation translates into the $187,000 for her. So this would be typical of other software, the assumption that everything Bill has goes to Sue, and then from Sue, ultimately to Bill Jr. Well, what we know in the case of second marriages and blended families is that that's simply not the case. So what I want to do is go back to the will tab. We'll leave TFSAs, RSPs is going to Sue. We'll leave the percentage allocation is going to, let me go to Bill's tab, is going to Sue. But what we're going to do is change the beneficiary of the cottage. And this is the issue that is being neglected today. So all I need to do is go to the beneficiaries entry and change from Sue to Bill Jr. And what we see, of course, is that when Bill Jr. receives the cottage, because it's a non-spousal rollover, then capital gains are realized. And, of course, the issue is that Bill's estate has to pay those capital gains taxes. So let's go back to Solutions in the Estate tab, and we'll have a look at what the implications of that are. So we can see now that Sue's still going to get Bill's half of the house, joint tenant assets. No longer is she going to get the cottage. What I have in here is that piece of art that I mentioned. We'll look at that a little bit later. she's still going to get the assets named outside of the will, TFSAs, RSPs, and so on. But notice there's no longer that percentage allocation, and the reason is that we have the same liquid assets, but now we have a far higher tax charge to the estate because of the realization of the capital gains on the cottage. We still have the probate fees and so on, and ultimately we have a negative residue for distribution. And this is the issue, because what that tells us is that on Bill's death, with the cottage going to Bill Jr. and the taxes being paid, Bill's estate is actually underwater. And the executors are going to have to come up with the money, and they're going to have to come up with the money by liquidating assets that would otherwise go to suit. And that might include, TFSAs, RSPs, and so on, to try and raise the necessary funds to pay the tax man and to pay probate fees.
Hi, Michael.
So if we're not modeling wills, it's pretty self-evident that we're actually misrepresenting the financial condition of the surviving spouse, in this case, Sue.
Michael, it's Jeremy. Can I just jump in for a second?
Yeah.
Unfortunately, I think there's some users that joined in late, and they don't know the contact details to get into the audio.
Oh, okay. So let me just go back to Makogo, and I'll just redo this. You're also going to be recording this, correct, Jeremy?
That's correct, yes.
So for those of you who may have joined in late, you'll have an opportunity to get the full recording eventually on our YouTube site. So what I want to do is, so are there any questions so far? Is everybody clear about the issue and how we can easily uncover that issue? So what I want to do is I'm going to create a new solution, and in it we'll go in and we'll model some of the typical things that can be done to address this issue. So first of all, to create a new solution in the software, and you can do multiple what-if scenarios all within the same file, I'm just going to the solutions page, copying the solution that we have now, and I'm just going to give it a new name. And in this case, I'm going to call it insurance. The obvious example is that we'll put some permanent insurance in place to take care of those terminal charges. So what I'm going to do now is go back to entries for bill, go to insurance, and I'm going to create a level benefit UL policy for them. And I'll make the death benefit about $250,000, which should be roughly sufficient to cover that estate liability. Now, one of the things that I want to point out, and I believe this is often overlooked, so to speak, because of probate fees, is that I'm going to leave the beneficiary as Sue. So let's go back to the estate output and see what the implications of that are. You'll notice that what we have now is the life insurance benefit going to Sue. But you'll also notice that the residue for distribution for the estate remains the same. It's actually a little bit bigger, and the reason for that is that the liquid assets of Bill's estate are not as much, because he had to pay the insurance premium. So that additional cost has lowered the final liquid assets and therefore increased the negative residue for distribution. So the reason I wanted to point this out is that very often in circumstances like this, what actually happens is insurance is put in place, and because of the concern about probate fees, the beneficiary ends up being the spouse. But that actually doesn't solve the issue for the estate. So it's important if we look at probate fees, they're approximately going to be $25,000. So what I want to do in this particular case is I want to go back to that insurance policy, and rather than making the beneficiary sue, again because it doesn't address the estate issue, I'm actually going to make the beneficiary the estate. The estate is what requires the liquidity. So let's go back to the solutions page, and again we'll have a look at the implications of this. And we see now that Sue's no longer receiving the insurance benefit. What's happening is the insurance benefit is going to the estate. And because it's going to the estate, we no longer have a negative residue for distribution. We have enough insurance in place to pay all the terminal taxes, probate fees, and so on. And what I want you to notice about this is that the probate fees barely were, higher, a matter of a few $1,000s. So what happens is we make people the beneficiary of insurance policies for estate planning purposes, when we really should at least consider the advantages of making the estate the beneficiary. It's the estate that has the tax issues. And the reason that I point this out is that if we did give the insurance to Sue, she could claim, well, this is my money, I'm the beneficiary, and we might be opening the door to legal issues, accounting costs, court costs, where Sue might want to challenge who should really be paying those terminal taxes. After all, they're a consequence of the cottage going to Bill Jr. So that could end up in something that could be very nasty and could be very costly as compared with a minor additional increase in probate fees by making the estate the actual beneficiary of the insurance policy. Now, there's one other thing that I want to just speak about on these insurance policies. Clearly, what happens is if we put a policy in place, then the payment of those premiums are, could impact Bill and Sue's retirement lifestyle. Money paid for the insurance premiums is simply not going to be available for, retirement lifestyle uses. So one of the things that I want to show you is that if we go into the insurance policy we put in place and go to the premiums, considering that the reason we have the insurance policy is that we're looking for liquidity because of the tax issue for the cottage, and that's to Bill Jr.'s benefit, we could go in and at some point in the future when Bill Jr. is an appropriate age, right now I have him as being 26, so we might go out into his 30s, for instance, and we might actually have Bill Jr. share the cost of the insurance policy. After all, he's the one who's benefiting from getting the cottage. Oh, there we go. So you can see now I've got Bill Jr. sharing in the policy, and if I go back to the estate implications, what we're going to see is that the residue for distribution is higher because we no longer have Bill spending as much money on the insurance policy.
Bob Noseworthy.
Any questions so far? I know that I'm showing a lot to you, but I want you to see the flexibility of all of this.
Yeah.
Now I want to. Sorry, go ahead.
When you put in that, with what you just did, if you go back there for a second,
Yes.
you added Bill Jr. as 50% payer on the policy.
Yes, and notice that when I did it, I didn't have to do it today. Bill's still 100% payer today. I've added Bill Jr. as a payer sometime in the future when, maybe he's financially more able to bear the cost.
Okay, why didn't the $5,000 after 2020 drop to $2,500 then?
Because it's still a $5,000 premium, but 50% is paid by Bill, 50% is paid by Bill Jr.
Oh, so
to answer,
all right.
To answer your question, if I go to net cash, and if I go out to 2022, for instance, and we go into insurance, you can see that we're talking the payment. Sorry, I could go down a level. Let me go to that policy. We're talking $5,000 paid by Bill, dropping to $2,500 once Bill Jr. Pays part of the cost.
Got it.
Okay?
Yep.
So there's one other thing that I want to show you, and I'm going to go to solutions, and I'm going to build on top of this insurance solution. So I'm going to call this solution insurance plus donation. So when we create these new solutions, we can back up to a previous solution, branch off in a different direction, or we can kind of put them together sequentially, if you will, like a chain. So in this case, I want to take the insurance, plus I want to make a donation. And what I'm going to do is I'm going to go back to the Will tab, and I mentioned earlier that I have a piece of art. And then rather than leaving the art to Sue, I'm actually going to donate it to a charity. And notice we also, by the way, have the ability to do cultural donations. For those of you familiar with that, let's assume it's some sort of Canadian art. And I'll use the cultural donation just because it's a little more evident when we look at the output. So the reason that I want to mention this is that often what we do is we talk about putting insurance policies in place, but one of the things we can do is we can actually donate anything. So this becomes a bit of an issue around what I'm going to call values-based estate planning. We may have a variety of assets, some of which are much more important to us than others. And by donating what are on a values basis, the assets that we have that are of lesser importance, then we can address some of the tax issues in order to keep the assets that are of greater importance. And we can see now the residue for distribution has jumped up about $70,000. And that would allow us to go back and rather than having to buy a $250,000 permanent policy, we could actually buy a $125,000 permanent policy. So we want to keep in mind when we're doing estate planning the ability to donate assets, receive charitable donations, and therefore reduce the cost of the insurance that people need to have in place. Any questions about taking that approach?
Michael, with respect to assigning value to an asset, I don't recall that being in any part of the values-based questions.
Well, when you're talking about a value to an asset, do you mean the value of the cottage, for example?
Well, no, that they value an asset like the cottage greater than the piece of art.
That's very true that we don't have some sort of questionnaire that allows them to rank that. It's more, is that David?
Oh, it's Jeff. Sorry.
Oh, Jeff. Yeah. It's more a conversation that we have with people. One of the things that some of you well know, Jeff, David, Ray, is that we talk an awful lot about working interactively with clients. The way financial plans are done, and you can certainly use our software to do a financial plan, is that financial plans are generally prescriptive. We create the plan for the client. Whereas when we talk about this whole next generation of life planning, we talk about working conversationally with the client. And the reason that we want to do that is exactly the issue that you've raised, Jeff. We can't really come up with an estate solution for somebody else where there may be one of these values-based trade-offs. You know, what about would you be willing to donate that art, and, you know, what's the impact? But if we work with them, we can show them the consequence of it, and then they can come to their own conclusion. And what they're really doing is they're balancing off, you know, well, we'll lose the art, but on the other hand, we'll reduce our insurance premiums, and that's going to have an impact on our retirement lifestyle. What's more important to us? So, you know, when we work interactively, it's really that values-based conversation really has to arise when people can clearly see for themselves what the implications are of the different trade-offs. And just to help them understand that, if we go to the Solutions tab, you'll notice we have a Compare tab. And the Compare tab allows us to go in and compare any two solutions side by side. So I could start off on the left, and I could keep this as the initial vision, and we could look at, you know, the total. Remember, this is the cottage going to Bill Jr., and then we could have a look at the implications if we put the insurance in place. And again, remember, we had Bill Jr. paying part of the premiums. And then we could look at the situation where we put the insurance in place and we donated the art. So we're able to actually go in and help clients see what the relative impact of these different possibilities are and just compare them side by side. Now, there's one more thing that I want to show you, and I've created a solution for this because it required a little bit of linking up. And this is one where rather than giving the cottage to Bill Jr., I'm going to bring up TrustWorks. What I've actually done is I've gone in and I've modeled in theory a testamentary trust, which is going to be set up, the Sue Smith Spousal Trust, on Bill's death. And in the VisionWorks solution, if I go to the Will tab and bring up the cottage, what you'll see is that I've left the cottage to the Sue Smith Trust. So in doing that, of course, what happens is the cottage goes into the trust. Because it's a spousal trust, it's a tax-free rollover into the trust. And you can see if I go to the cottage that it's being transferred into the trust at the value of the cottage, projected value of the cottage at the time the transfer is made. But what we're able to do then in this situation is we're able to defer taxes until Sue's death. And then at that time, we can indicate that Bill Jr. is going to be the beneficiary of the cottage. And it's when the cottage then comes out of the trust, when the trust is unwound, that the capital gains will hit. And the capital gains will be the original ACB of the cottage, and, you know, or rather the value at the time of Sue's death, less the original ACB of the cottage, not the value when the cottage was rolled into the trust, but the original ACB of the cottage. So the consequence of that, of course, by rolling it into the trust, is that we're going to have a much higher tax bill, you know, the value of the cottage in 2040 as compared to a Bill's death in 2033. But if we're talking about a younger spouse, We could, for example, move some funds into the trust to pay the maintenance costs on the cottage, but also we could put in place an insurance policy on Sue. And it could very well be that the cost of that insurance on Sue is much less than the cost of the insurance that we would have to put in place and bill. Now, if we go back to VisionWorks, and we're in this trust solution, and we go to the estate tab, what we see here is that the cottage is now going to the Sue Smith Spousal Trust. We still have the liquid assets for bill, but we're not paying any terminal taxes on the cottage itself because it's rolling into the spousal trust tax-free. So the reason I want to bring this up is that there are a great many advisors where using trust has a considerable number of estate planning advantages. And unfortunately, there's no proper trust software in the marketplace today except for TrustWorks. So again, it's one of those things where we can conceptually talk to people about trust, but if we don't have any ability to actually model them, to be able to show the client in their unique circumstances what the advantages of a trust, then what they have to do is they have to try and grasp the advantages conceptually. And I believe very strongly that, for our clients really to clearly see something, they actually have to be shown it. They can't be just conceptually told about it. So we have this very robust ability then to properly address the estate issues for second marriages and blended families, whether it's by the use of insurance, including the beneficiary of the asset sharing in the insurance premiums, whether it's by donating virtually anything that we want on a values-based trade-off basis, or whether it's being able to show people the advantage of a trust, we're able to, have a very rich discussion about them. And again, just to remind you, what's happening in today's world is we have a 43% divorce rate, lots of second marriages, lots of blended families, and regrettably, software that's being used can't model this. And so if assets are going to children from a previous marriage, then in many cases we're actually misrepresenting the financial circumstances of Sue, the surviving spouse. So any questions that anybody has?
And Michael, it's Ray.
Yes, Ray.
I'm wondering if you go back to the will tab and you had percent allocation.
Yeah.
And if you're going to be wanting to make a percentage allocation to charity, but you don't want to designate, I'm guessing if you designate specific assets, that would be outside of this percentage allocation.
Yeah, absolutely. If you take the cottage or the art that we did,
right?
If you got a specific asset, what a will do is it will say my piece of art is going to such and such a charity. It will actually be designated in the will. Yeah, but percent allocations apply only to the residue of the estate. They don't apply to specific assets. So let's just review this concept for a second. The point of registered plans, TFSAs, RSPs, and so on, is that they're actually trusts. And as a trust, we can designate a beneficiary of a trust. Hence, we can designate a beneficiary of an RSP. We're not designating a beneficiary for the assets within it. We're designating a beneficiary for the trust. That is not true of a non-registered portfolio or a bank account. Non-registered portfolios and bank accounts go to the estate automatically. And so the value of non-registered investments that are subject to the percent allocation. And the reason we can't designate non-registered portfolios open money is because literally, not being a trust, we would have to go in and we would have to designate a beneficiary for each security or mutual fund. So every time we bought and sold a security or mutual fund, we have to fill out new designation papers. Now, of course, seg funds are a different story, but I'm speaking of non-seg fund open money. So for that reason, bank accounts and because they're not trusts, bank accounts and open portfolios, whatever the liquid assets are in them, automatically simply go to the estate and then are distributed according to the percent allocation in the will. After, of course, all terminal charges, taxes, probate fees, funeral expenses, outstanding liabilities, legal and accounting fees, and everything else. Any other questions? So one of the things that I want to point out, and it's fairly obvious, is not only are we in many cases misrepresenting what Sue, the surviving spouse, is going to get, but we're also missing opportunities. If we're able to model wills, able to uncover what we call the estate gap, then we're also able to help the client solve the problem. And in a great many cases, that's going to lead to a permanent insurance policy sale. So, we believe that not only are we doing something very beneficial for the client by addressing this really neglected issue, but we're also, doing very good business for ourselves. So for those of you who joined in after we started, you know that our sessions are subject to CE credit. So I'm just going to go back to our website, and all we would ask you to do is return to the website, and next to that webinar page where you joined in, if you would go to the Contact Us form and then just complete it, and where it says comment down here at the bottom, if you would just type in estate issues, then we will have the necessary contact information to send you the CE credit certificate. So I
have one question, Michael.
Yes, please.
It's Jill Chambers. You mentioned at the beginning that we could demonstrate the impact of not having a will.
Yes. Oh, you want to see that?
Yes, please.
Yeah, sure. So I'm just going to go to our initial vision that we started with, and I'm going to create a new solution for that, and I'm going to call it No Will. So you can see the ability to create these solutions, very easily, and then go in and, make any changes we want. In other software, you've actually got to create a new file and then, make changes in the new file. And here we can just do everything all in one, file. And the great advantage is our ability then to go in and do all of these different comparisons. So all I need to do is go back to the Will tab, and for Bill, I'll deselect that checkbox. And notice the dollar allocation, percent allocation tabs are disabled. Those are things that apply to a will, as are all the entries in the tree view. This does not pertain to beneficiaries of TFSAs and RSPs and so on, because they're named outside the will. And if I go back then to the solutions page and the estate tab, then we're going to see what the implications are. We can see for Sue, she still gets Bill's half of the house, etc. But the cottage is no longer going to Bill Jr. And it's provincial intestacy laws. And the provincial intestacy laws in Ontario are that the first $200,000 goes to the surviving spouse. then all the other assets, the value of the cottage, the value of the art, are liquidated. And in Ontario, you can see the value of all of that is $1.3 million. And in Ontario, the value is shared 50% to the surviving spouse. So we see Sue gets half of the $1.3 million, $674,000, and then the other 50% is split amongst the surviving children. In this case, we only have one child, so Bill Jr. also gets $674,000. So we're able to very easily show what the consequences are provincially of not having a will. Does that answer your question, Jill?
Yes, it does. Thank you.
Okay. Any other questions? So I want to thank you again for your time today. I'll remind you that in a month we're going to do another webinar. That one is actually going to be on rental properties. And the reason that we chose that is that, again, other software doesn't properly model rental properties. And one of our experiences in handling support calls is that a great many clients today have diversified into rental properties. So we think it's very important to be able to model them correctly. And one of the things that we've experienced is situations, for example, where people might have a very large house. They've diversified into a condo, let's say, as a rental property. And then what their intention is at some point during retirement is they'll liquidate their house, and what they'll do is they'll move into the condo. You know, they don't need the big house anymore, so they're going to convert the rental property to a residence. And so being able to model rental properties correctly in the first place is obviously important in accurate planning. But equally important is the proper tax treatment of the conversion of the rental property to a principal residence. And it depends on a number of factors. So again, this is the kind of thing that's becoming, reasonably commonplace. And to give people an accurate understanding of the implications, we need to be able to model things properly. So we felt that that was a very timely topic as well. Anybody with any other questions?
Michael, it's Ray again. Just quickly,
Yes,
is there a way to print this information that you've just showed us here about the wills?
Sure, absolutely. Let's go back and we need to re-enable the will. If we go to do reports, and as you well know, Ray, we've been doing a lot of work on our reports. I hope by Friday we'll have the next version of the software out, and I think you're going to be pretty amazed at all of the new stacked bar graphs and tables that we've included. So if we go to the report, and I'm just going to select the state type output. We can go down to beneficiaries, wills, other beneficiary designations, and we can go down to the estate summary, the forecasted estate value and the residue for distribution. And then when we do a print preview, we'll just bring up those sections of the report. And I just mentioned this for people who haven't seen this functionality before. And you can see the table of contents was dynamically built just based on what we selected. But we can go in now and have a look at who's getting what. So we haven't put in any of those expenses, but we can see that Sue's getting Bill's half of the cottage. On Sue's death, it's going to, if Sue were to die, Bill would get her half of the cottage, depending on who dies first. We can see that the cottage, though, in this situation is going to Bill Jr. The art right now is going to Sue. This isn't the issue where we made it the estate, made it a charity. And then if we go down, we can see, who's getting what percentages of the dollar amounts. And then, sorry, let me just go up here. If I page forward, we see the other beneficiary designations in the terms of percentages. But then if we go to the forecasted estate value, we can start to see the value of all of these things. So on Bill's death, Sue gets Bill's half of the house, assets named in the will. Bill Jr. gets the cottage. Sue gets the value of the registered plans. We can see the total value of what's going to Sue, what's going to Bill Jr., and so on. And then we can see what happens on Sue's death, what Bill Jr. will end up with. And as you know, Ray, all of the text is completely editable. So we have some default text in there, but you can go in and change all of that, both as your default, or if you prefer, you can also edit it for specific clients. So discuss what, you know, the tables are showing. Anybody else with any questions?
Yeah, can you slip back and just show us where to apply for the credits?
Oh, the CE credit. Yeah, you just have to go to our website, and when you went to the website to log into the webinar today, you can see the webinars page here. Just go to the next page, the Contact Us page, and then all we'd ask you to do is complete all of that information, and then, you know...
I click on it and there's nothing there. It just says registration type, personal, company, comments. It's not all that what you put in there.
Try using a different browser. Just maybe the browser that you're using for some reason is blocking it.
Certainly Internet Explorer?
Yeah, well, I'm using Internet Explorer too.
So on the contact page, what shows up for me is please complete all fields, just the same as you at the top there.
But none of the name, etc.?
It doesn't have from company name down on your screen. It's got registration type and then comments.
I don't know why, because we're both using Internet Explorer. Try Google Chrome.
I'll have to load that one. That one seems to, Google Chrome seems to interfere with a couple other programs that I run.
Well, then I'll tell you what. All you need to do is send an email. Let's make this really easy. Just go to that Contact Us page, click Info at Vision Systems Corp, and then go in and just say estate issues under subject. Put in your name and, you know, whatever else, so we have the necessary information to be able to send you the CE certificate.
All right. Thank you, Michael.
Okay. Anybody else with any questions?
One last thought, Michael. It's Jeff again. I imagine with this software, like I've come across, and I'm sure everyone here has to some degree as well, the delay in the will making. More than once, you know, the fellow's on his deathbed kind of having the last minute thing done. But what about institutional executorship? Is that easily modeled in here in its expenses and so on like that? That is to take a trust company and act as the executor versus a family member or something like that.
Yeah. You notice you can go in and do executor compensation. It's on the will tab. And you can do it either as a percent or you can do it as a dollar amount.
Okay. Okay, good. Thanks.
And then if we were to put it in, let's just put in $5,000 just to pick a number. You'll notice when we go down to solutions and estate and look at the actual charges to the estate, that, hang on a second, if I click show table, you'll notice that now shows up. And you can see here actual in today's dollars. If I switch to today's dollars, it's $5,000. But considering we're talking about 20 years from now, it's actually going to be an $8,000 charge to the estate.
Yeah, and if you could do it by percentage, like you indicated, correct?
Yeah. Yes, or we can do it by percentage, and then it's a percent of the value of the estate. Absolutely.
Okay, thank you.
You're welcome. Anybody else with any questions? So again, I want to thank you all for your time today. Please remember to, send us an email or complete that form, whichever is actually the email might be more convenient. Just make sure that we have, the necessary information to complete your CE credit. And if anybody has any questions that pop up and that you'd like to discuss, again, feel free to go to the contact page in our website. Our phone numbers are there, or, the email is there, and you can send us any questions you want. Jeremy, do you have anything you'd like to add?
Nothing really at all, but we did mention it briefly there that we will have a recording of the entire webinar up on our YouTube channel shortly, and that's accessible via, Michael, if you want to scroll up a little bit on the page.
Yeah. On any page of our website, let's just go back to the home page. All you need to do is click the YouTube logo in the upper right corner, and that will take you to our YouTube site. And you can see that we have a number of webinars on here. One of them, as an example, is Donations and Vision Works. Another one, which we didn't discuss today, is actually modeling a couple who are in the midst of divorce. It's extremely easy to do and very accurate. And, one of the big issues, of course, for divorcing couples is, it can get sometimes a little contentious. One person wants to hang on to all they can. The other person wants to get as much as they can. And it's all out of fear of the future. Or it is in many cases. And you can actually model a divorcing couple, sort of the pre-divorce circumstances, the post-divorce circumstances, what Bill will end up with, the post-divorce circumstances, what Sue will end up with, including things like, support payments for children and so on and so on. So there's a video that shows you how to do that. You can see that we did a video a month ago on client discovery and engagement. So what you'll see after we finish this webinar is there'll be another video up here that will talk about estate issues. So again, thank you very much for your time. If you have any questions, feel free to give us a call. Thanks.
Thank you.
Thank you.
A pleasure.